All right. Welcome, everybody. Thanks, Sean. Man, that was a great conversation. We'll talk a little bit more about the running here in just a couple minutes. Sean, welcome. Real quick before I welcome our guest today, want to say welcome to the CRE Playbook. This is your weekly spot for deals, strategies, and tactics to level up your real estate game. I'm absolutely a huge fan of today's guest, Sean Sundwall. Great friend, great person, and somebody that I certainly look up to in the business space and the insurance realm, and all things multifamily. A great guy who's taken care of a lot of fellow investors of mine. Sean, welcome. Thanks for joining us today. How are you?
Thank you, Carlos. Very kind words and Happy New Year.
Likewise. Yeah. Happy New Year. Yeah, this is the first session since the new year. How's 24 been?
Well, just barely 4 days in. It's been fantastic, sort of easing back into things. And no, it's been great.
So we'll hit on a lot of topics today, but one thing that, when we talked about, you just mentioned 24, that just blew my mind was, how well the stock market did in 23 when we all, I think going into it, were really expecting traditional equities. And obviously this is a CRE, but we tend to talk about macroeconomics in general too. But, how well the stock market in general did over 2023, whereas we all expected, I think the entire market expected the stock market just to perform really poorly. And I think the opposite happened in terms of, CRE, commercial real estate, especially office, retail, really took a heavy hit in terms of valuations. And, multifamily certainly has seen quite a bit of devaluation as well. And I think, there's the one phrase, survive till 25. For me personally, we closed on a couple transactions in 23. Looking forward to closing in a couple more in 2024. So I think the sentiment is still, there in the marketplace from those that I'm talking to. But, again, you being a great service provider, what are you hearing in terms of, your clients and folks that are bringing deals to the table? Have things slowed down?
Yeah, I think they've certainly slowed down. I think the stock market has been maybe not the only, but certainly the bright spot in the larger financial arena. Obviously, interest rates are a big drag right now, both residential and commercial. So I think that's been a pretty key contributor, I think, to what I've seen as slowdown in terms of transactions. My business hasn't really slowed down because it's not dependent on new transactions,
Sure.
but I have seen new transactions go down just in my realm. And the ones that do go through have just taken longer. So,
Yep.
we've heard the R word for 2 years now. And I don't think technically, at least definitionally, it hasn't happened. I keep
Right.
hearing it's going to happen. And the stock market has seemed to ignore that.
Yep.
Whereas other sectors, I think, of the financial industry have sort of played into it. So, I mean, who knows what will happen in 2024. But what I have also found is it seems like there are good deals out there to be had if you have the backing and intestinal fortitude to power through.
Yeah, I think there's some fundamentals leading into the 23, leading into 2023 that happened. That I had some conversations with some big developers here in the we're in the Seattle market that they were saying if you're a good syndicator and not a good operator, you won't do well in this coming market. If you're a good operator but not a great syndicator, you'll still do well. You just won't close on many transactions. But the folks that have the ability to raise capital, structure deals, and operate appropriately, they're the ones that are still getting deals through to the finish line.
Yeah.
And I think that's where, for the folks that are, listening and that aspire to continue closing on multifamily and commercial real estate, you really got to focus is, again, the operational side, building out the operational side, as well as tying in the ability to raise capital. So I know we jumped into this. We got, it was probably my fault. Sean, before we go any further, I'd love to hear from you, your journey, your journey, what you do now and what you are continuing to do and where you want to be, where you want to continue to grow.
Yeah, I'll try and condense this as much as possible. I just turned 50 last year, so it feels like my life has been long. But I got a communications degree from Brigham University way back in the day, did PR for 13, 14 years with some of the biggest companies in Puget Sound, including Amazon and Microsoft. What got me into insurance and real estate services really, honestly, was a layoff back in 2011. And still, I think, as the economy struggled, even in Seattle, to get back from 2008, 2009 disaster. And a buddy of mine said, "Hey, you should try sales and insurance," which I'd never really done before. And really, the last 12 years, the rest has been history. It was a fantastic transition for me personally and financially, and plan on doing it for another 15 years.
Great. Now, I think one of the things that really attracted me to you in terms of the sales process, I think you were the one and only agency to really tie into some of those new LLC formations. You had a really dialed in process on the sales side. So kudos to you for building that automated process, and whether there's automated, manual. Again, you did a great job on the outreach, so congrats on that. Insurance. So tell me a little bit more about the insurance space that you're in. All commercial real estate, residential, all over the place, or you
focused?
I
mean, technically, me and my agency, we do everything except health insurance. So life insurance, home auto, all the traditional stuff, traditional business insurance, like, hey, I own a restaurant, I need to cover the operations, blah, blah, blah. Most of that is done by other people in my office. I focused, we rolled out a product 3.5 years ago we call Hab Fusion. That really changed everything for our company and for me. And I personally pivoted to that. And that's basically Hab is any building that somebody works in or lives in. And so I pivoted to that, ended 2022 and 2023 as the second largest writer at American Family for that product line. So it's been fantastic. So we do everything, but I focus on multifamily, which is so we got connected, and any other sort of commercial property.
Nice. So what's new or what's different? What's more attractive about the Hab over either traditional products or what you were doing before? Is there any difference?
Well, I mean, one of the cool things about home and auto is everybody has them, right?
Yep.
And everyone can relate to that. They know what a deductible is and blah, 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 blah. So while that's stable, it's not very interesting, at least to me. There's not a month that goes by that I don't meet someone like you or some other investor or property owner that has a very different story, bringing to me a very different type of risk that keeps things very interesting and keeps me mentally motivated. And so I think that's what's been, obviously there's good money in it as well. And increasingly so, but I think the stimulation that the variance and the variety brings has been the best part.
Sure, no, it totally makes sense. I think the change in business, right? The change in focus, I should say, really keeps you engaged and on your toes. I think that's the exciting part. I think, you mentioned risk. I think that to me, insurance, the entire spectrum of insurance is all related to risk mitigation. Would you define it or look at it from a different perspective in any other way?
No, I mean, I would say it may be slightly different, but I think it's the same thing. It's risk tolerance. How much are you as the property investor willing to take on? And that often comes in the form of how high your deductible you're willing to have, right? But there's also specific coverages that, do I have earthquake? Do I not have earthquake? The one in Seattle is supposed to happen either today or some in the next 150 years.
Yep.
Right. So how much risk are you willing to take on as a property owner or investor versus how much do you want to outsource, AKA pay for someone else like an insurance company to take on?
Sure. Totally makes sense. And for those that aren't in Seattle, maybe, right, we've talked about, we have products over on the eastern side of the state where, URM, unreinforced masonry is here in Seattle is an absolute faux pas. It's not something that we like. We don't want to do it because unreinforced masonry is going to be incredibly susceptible to any kind of earth shake, earthquakes, earth movement. And so, those types of products, I tend to stay away from. B, if it's just a screaming deal where we're getting it, $80,000 a door in U district, then there could be a case for it. And in which case, you're layering on additional insurance products, additional insurance coverage, like Sean, you're mentioning earthquake insurance. Now, obviously the alternative is to go in and retrofit. retrofit the building, which both are insanely expensive. I think though, as an operator, again, like you said, you have to realize, you have to figure out what's your tolerance for risk.
Right.
Is it better to reinforce it and not insure, or is it better to not reinforce and insure it and then sell it to the next investor, next buyer who may have a different plan with it, right? Maybe they redevelop it, maybe they go in and do the retrofitting. So figuring out your game plan first.
Correct. Yeah, that makes sense.
Good. So, one of the things that we had talked about beforehand was a little bit about, I know you and I have had these conversations briefly in the past, and a lot of other investors that I've had conversations with is about, increasing increasing premiums on the insurance and how that's working and what's causing it. Is there any way to insulate or mitigate that as a property owner? Help us understand again what's causing it. What, from your perspective, what's causing the
Yeah.
premium increase?
The industry is a dumpster fire, to be totally honest. I mean, anybody who spent 5 seconds even as a property owner or property manager has recognized that something's wrong. They may not be able to put a finger on what it is, but they know something is different than it's ever been. And the challenge we have in the industry is I'm not aware of any company making money in the HAB space. I don't think anybody is. And so the question is, how do insurance companies, some are leaving altogether. I won't name names, but there's some very large companies that are exiting the space altogether. And those who are staying in it are having to make very difficult underwriting, not just pricing decisions, but underwriting decisions in terms of eligibility. What are we willing to take on? And you and I have talked about this numerous times lately, is unfortunately, many, if not most of the good deals are on old buildings.
Yeah.
Right. And when I say old buildings, I'm talking especially in the Washington area, getting into Seattle. It's pretty hard to find a building that's that's post 1950 or 1960. Right. And so one of the decisions that American Family and many others are making is we can no longer insure those types of buildings for replacement costs. And we can get into a conversation about replacement cost versus actual cash value. But basically, replacement cost is the gold standard. And that's what most lenders require. If you bring to me a 1924 building that you just replaced the carpet on and some cabinetry, right, and it's still to the core that 100-year-old building, most insurance companies are not going to be able to offer you that. You're going to have the actual cash value, which is a depreciated amount of cost, which is another risk you have to figure out as a property owner investor, whether or not you want to take on. And the challenge with that is that's where the deals are. And the other challenge you hinted at earlier is who is going to spend the capital to tear that thing down to the studs and make it a new building, because you can't get that out in rents. It doesn't pencil to do that.
Nope.
And so the number one thing, you and I, again, have had this conversation. The number one thing I tell people is buy something in the 70s or later, even if that means you're not getting a property that has the very best deal. Mm-hmm. That's just from an insurance perspective, but that's becoming a bigger thing, right? It's not just how much do I pay, it's can I find it?
Yeah, I think that's the tough part, right? Like you said, at this point, if we go back again, Washington and specifically Seattle and the Puget Sound area, you go back in time from the 50s until the early 2000s or the mid 2000s. You look at the construction phases, and really, especially in Seattle. I mean, the amount of single family zoning was just so prevalent. Multifamily and commercial zoning was so condensed to the core of Seattle that there just wasn't a lot of building that was happening pre 70s. And so I think, what I and other operators will experience is, as we're trying to scale this business, as we're trying to scale the multifamily space, it becomes increasingly more difficult to do so in Seattle, not because the operational, is difficult to manage, that kind of thing. There's ways around that. There's ways to actually manage successfully in Seattle. I'm talking more so about the available stock or the available inventory of products that are in that 100 plus, 150 plus unit, let's say class C, class B, in that they were built in the 70s, between the 70s and the late 90s. That I just don't even, I think that there's probably maybe five. I'm throwing out a number, but a very, very small number of complexes that were built in the 70s, the 60s, 70s, 80s that were of a decent size. And so I think that from a scalability perspective, it's difficult. Um, and so we're forced to go back and look at the 20s, the 30s, 40s. But even still, the sizes are small, and then we're having to deal with cash value, which, like you said, is from somebody who doesn't like risk. It's not something that I want to continue to pursue.
Well, and it's also something your lender may not approve.
Sure. Yeah.
And
I
so
mean,
that
flat
puts
out,
you in a
right?
real tough.
Yeah.
Yeah, I mean, you and I
It
had this
doesn't matter.
issue a month ago,
Right.
right? This very same thing, right? And so where I have seen a little glimmer of hope, although I think the number of people who are capable of doing this are still a small number. And by the way, I've seen this issue in Boise, I've seen it in Salt Lake City, I've seen it in Denver, because I'm licensed in 18
Yep.
states. And these core downtown areas, most of them have not been revitalized,
Right.
right? And what I start to see in Seattle, and I know some of the development restrictions in King County and in city of Seattle are very difficult, but where I've started to see redevelopment of properties where people either knocking down or tearing down to the studs something that maybe was this particular type of use, but now they want to make it into multifamily use. There are still many single family homes in Seattle that can and probably should be torn down and redeveloped.
Yep.
The challenge becomes that's a different investor path, right?
Yep.
That not everybody's equipped to do.
No, and I think, certainly so. You can see that in, who was it? CoStar put out that report in the summer of last year, in July of 23, stating something to the degree of construction starts in the first half of 2023 reduced by over 60, I think it was 65% for Seattle and Washington. Because, well, obviously a couple of reasons. I think, cost of capital was probably one of the leading ones, but, all across the Western seaboard, is it, construction and permit pulls, right? New permits being issued is the measure that was being talked about. We're really starting to see this drastic drop in new inventory coming online. So, I think that goes back to, we're probably going to see in another 10, 15 years, this, gap between 2023, 2024, 25, just almost no new inventory that was brought online. I think more so 25, because we're still processing a lot of the 23 and 24 permits. But starting in 2025 is when new supply just falls off a cliff.
Yeah.
And it becomes difficult. Like you said, it's a different investor that wants to take on covered land, right? Go in, permit, entitle properties to either change use or completely redevelop. And that's just, right now, the yields aren't there because the rent growth isn't there.
Right. Yeah.
So,
It's a rock and a hard spot, right?
yeah,
It's tough.
absolutely. So tell me a little bit more. I know we're running short on time, but tell me a little bit more about, as a property owner, what's something that I or somebody else could do to help mitigate risk on increasing premiums. Maybe a little bit better way to say it is, how can I get better predictability around increasing risk, increasing premiums on insurance?
Yeah, great question. So I think the idea is what we have to focus on, as with anything in life, is what we can control. Rates
Sure.
are going to continue to go up, whether or not Carl files a claim or not, right? Because with the weather changes that are going on and wind, hail, and all these kinds of things, it's just going to continue to go up. But there is a portion of that each policyholder, property holder can mitigate. So first of all, deductible is an easy way to manage things. Second of all, be very, very leery of filing a claim. We as consumers, and I think even as investors, have gotten in the habit of, oh, insurance will cover that. That shouldn't be the question. The question should not be whether insurance will cover it or not. The question is this a loss that I am willing to lose insurance coverage over? because I'm telling you, I have brokers calling the last 18 months. I have more brokers calling me than people like you.
Sure.
And we used to be miles apart on our ability to cover things, but I've got the largest broker in Seattle calling me and emailing me regular saying, hey, can you do this? Because my markets cannot. And almost every single one of them is because they're getting non-renewed.
Sure.
Right. And largely because of claims. Guess what? I can't take you on. If you've had a claim in the last 3 years, I can't even take you on. So not only do you run the risk of being canceled or non-renewed by your current provider, you make it exponentially more difficult to find new insurance. And so that's probably the number one thing. And this is what I always, you and I have had this conversation also. This is why I always encourage people before they file a claim to come talk to me first.
Sure.
My job is not to dissuade you from doing it or not. It's to give you the information that you will need to be able to make that decision. And it's not just a money decision.
Right. No, I think so. I filed one claim in my entire life, and it was a tough process. Both in just understanding how to do it and understanding, how the whole adjudication and appealing process, all that kind of stuff. It was difficult. Anyway, I've only filed the one, and before that, I'd probably had an opportunity to file 5 other claims. Now, for me at the time, most of them were cost benefit analyses, specifically on a dollar perspective, right? So I had a townhome in Seattle that was broken into. All of the electrical was stripped, and it was a complete loss in terms of the electrical expense. So, we looked at it from a hard cost perspective, $12,000 to rewire the whole thing, or I don't remember what my deductible was. Let's call it $7,500 or $5,000 to the deductible. Is it really worth? Is the $5,000 in that instance really worth the risk of a non-renewal, B, essentially becoming a non-start for another project? And that particular example, no, it was far more advantageous for us just to pay the delta of let's call it $5,000 to rewire the place.
Yeah, and that's the right way people need to think about it. I mean, insurance, we need to think about insurance as catastrophic coverage.
Yep.
And nothing more, nothing less. And I guess the only other thing, this is a little known secret, but maybe a third thing, and this is somewhat in your control and somewhat not in control. It also depends which municipality you're in, honestly. But tenant credit score is a factor.
Huh.
So just like with your auto insurance or your homeowner's insurance, your credit has a significant impact on what your rate's going to be. So does your tenant score. We don't have a way, we don't pull Carl's credit, right, for the property he owns, but there are services out there that provide average credit scores for tenants inside of a building. And believe it or not, just like credit score is the number one predictor of claims in auto insurance, it is a top predictor of claims in commercial space. If you think about it dispassionately and not about a particular property that you might own and the people you know that are in there, it does make sense.
No, I mean, it absolutely does. Like, I'm looking, considering my 30 unit apartment, and I'm as you were mentioning this, going through the folks that I know that we've leased to, and like, okay, they're satisfactory. So my thought is going back to the legacy tenants, right? The tenants that we essentially inherited. I don't inherently know off the top of my head what those credit scores are, but I'm going to go back to our property managers and see. Well, I guess the question to you is, what as a property owner should I do? Is it a regular touch base with my insurance agent? Is it something that you regularly do to just double check and change premiums? How is that information used?
Well, and I don't want to be too Washington specific in her, but Washington's law is if you're going to use credit, you have to check every year.
Sure.
We would like to check every 5 to 10 years because we don't want to do the ups and downs that come with that. But Washington, in its infinite wisdom, has said you need to do that every year, right?
It's a lot of work.
And so we don't like that. The problem with, yes, we can have that conversation as your agent. I can certainly have that conversation with you. but it's already too late. Because the impact of those credit scores has already taken effect. Now, it might be that they're good, and so
Sure.
that's a great too late, right? But as a landlord myself, I don't have multifamily, but I have several single family properties. So I've sometimes just because the market's good, like they're willing to pay me a lot of rent, like I don't do a credit check, and that's
Sure.
crazy talk, right? And now I can't speak to the legalities of this, and I know it depends, even in post-COVID in Washington, it depends on where you are. But I would be as prudent as you can about having a cutoff of what you find acceptable in terms of credit.
Yep.
And insurance aside, that's going to make typically for a better experience as a landlord than regardless of the insurance impact. But it does impact insurance.
100%. I honestly haven't heard of anybody in my space or my network not checking and not, considering credit an important aspect of the quality of a tenant. I mean, that's one of the reasons why I love I'll say the North Seattle market is, all of our tenants all of the tenants that I rent to have credit scores that are, I would say, within, 5% of mine, right? Low to mid 700s would be theirs. And then their income to rent ratio is great. So yeah, I
Yeah,
mean,
I would
very
say
predictable.
I would say though, I'm got to be careful how I say this, but I mean, there are parts of the greater Seattle area where you'll have really good multifamily deals
Sure.
and they're dumps, right? The question is,
Yeah.
why are they dumps? Are they dumps because they're just not maintained, or are they
Yep.
dumps because the people in them don't maintain them,
Sure.
right? And
Yep.
that's what I think you have to really look at. There's so many problems you can inherit by a quote unquote good deal.
Sure.
And I know cap rate and all those fun mathematical equations make a lot of sense. But at the end of the day, I think we have to ask ourselves, is would I put my mom in there?
Yep. Yeah. Headache rate is not a quantifiable
Right.
metric that enough of investors use. And that's why I also caveated with North Seattle,
Right.
is the buying pool. But anyway, great feedback, and thanks for that answer. So I know we are running low. I want to get to this week's triple threat. Our 3 questions that ask every single guest that comes on, talking about what did you do physically, mentally, and where you're going to, what's your target financially. So Sean, what's something, I know we talked about on the front end, what's something that you do regularly from a physical fitness perspective?
For most of my life, I've been a runner, long distance marathon runner guy. I'm a little old to be competitive anymore, but I still maintain about 5 days a week getting out there running. And so my goal this year is to extend the length of time running back closer to what it used to be when I was a young
Nice.
spring chicken.
That's awesome.
Yeah. So part of that though is eating better. I've let my eating go to pot. We talked about this on the pre-show, but so I have some pretty strict expectations around some of it's tied to weight, but mostly just tied to eating better. So that would be physically. Mentally, I'm a licensed pilot, but have let my stuff lapse, and so I'm jumping back into that. And while that sounds like in the fun bucket, it's also a very mentally challenging exercise. So I'm looking forward to relearning some of those things and getting back up in the air more consistently. And then financially, I would say, obviously I want to make lots of money, but I want to be more prudent about actually really want to get into multifamily. I don't know if I want to do it in Washington,
Sure.
but I really do want to get into multifamily. The idea of my single family homes being either 100% occupied or 0% occupied is a little less appetizing. And as we move some capital around, I would like to venture into that 4-plex, 8-plex, 12-plex type thing, and maybe even sometime down the road in the commercial space. But residential is what I'm familiar with. It's what I like. So I think that's my next step on the horizon of what I want to do
Nice.
financially.
Do you have a state in mind?
My kids are all in Utah, so Utah's in mind. Idaho is somewhat compelling. Washington is fine. I have a rental property there or here, but it's just, King County's tough. King County's tough. And the Washington, the state tax and the death tax and things, those are things you have to really pay attention to long term.
Yeah, for sure. Montana is another one that you should take
Oh,
a hit at.
Yeah, I'm up in Big Sky every year for ski vacation, so I
There you
should
go,
look at
man.
that.
Well, cool. And on the flight side, I have been seriously considering getting my private pilot's license, simply just to take the four-seater Cessnas out to our properties in Wenatchee, Spokane, and just cut the drive time.
Yeah, I'm sure there's a tax write-off built in there. A little tough in the Seattle area to fly regularly in the winter, but there's no better prettier place to fly than Seattle.
There you go. Well, good stuff, Sean. Where can folks get a hold of you?
I guess it's okay to put my phone number here. It's 425-922-5844 is my phone number. And you can go to SeanSundwall.com. That's SeanSundwall.com with all my contact information. I'd love to help people out.
Perfect. Love it. I'll leave that in the show notes. And Sean, I appreciate you. Great chatting. And yeah, let's get on the trail soon.
Yeah, good to talk to you, Carl. Have a great
All
day.
right. Take care. Thanks, sir.